Hello, everyone, and welcome to this quarter's YCharts Economic Update, where we're covering Q1 2023 data. And as we do every quarter, today we're reviewing our latest economic deck with visuals and data that summarizes what happened in Q1 of 2023. And our hope is that this data can help you navigate whatever is in store for the back 9 months of the year. I'm Joe Clevin, Senior Analyst here at YCharts, and this time around, I'm joined today by my colleague and good friend, Zach Middleton, who is in our Customer Success Department. How are you, Zach?
Doing great, Joe. Doing great. Excited to talk more about what's happening in the wider world around us.
Excellent. Well, as am I, and let's get to it then. Just a couple things before we get started. Clients of YCharts, we're delighted to have you here with us. And if you want to access the deck that we're about to go through and download a copy for yourself, you can log into YCharts and go under support topics, resources, and presentation materials to access the deck. I'll actually show everyone how to access that right now. So here we are in YCharts, just on the dashboard homepage. If you go to the top bar under support, you can click resources. And right here in the fourth tab will be Economic Summary Deck. Q1 2023 will be preloaded there, so you can just go ahead, click download, and that will download a copy of the deck right to your desktop. And even if you aren't a YCharts user yet, you can download a free abridged version of the deck to get a feel for some of the data that's inside it and what might be possible if you were to become a client. The easiest place to access that is actually through our blog post, which I can also take a quick showing here. So if you just go to our blog here at get.ycharts.com/blog, we have that right here front and center, the Q1 2023 econ update. Just pop your email in here and you'll be able to download the deck right from there. Just a few reminders before we get kicked off. Do keep in mind that the content of this webinar is meant for just educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Number two, nearly all the data we're reviewing today was published by different government agencies, as well as a few private providers in mid-April, and data is as of the end of Q1, which is March 31st, 2023. If you'd like to look at the most up-to-date data, up-to-date data, please feel free to hop into YCharts and explore for yourself and start a free trial if you're not currently a client. We encourage you to do so. And three, finally, we will be emailing a recording of today's webinar and a copy of the deck to all attendees. You can expect that in your inbox tomorrow. And this will also be available as a replay on our YouTube channel for further access down the line. So remember to like and subscribe to our YouTube channel so you don't miss out on any of our newly released videos that cover everything from webinars like this to informative how-to videos that cover YCharts, the tool, as well as other, like I said, webinars that feature some of the biggest names in the industry. Okay, well, with that all being said, I will now pass it off to Zach to get us started with some of the data. Zach, take us away.
Yeah, thanks, Joe. So we'll kick things off with a few charts showing some major index performance here. Excellent. So we can see U.S. stocks kicked off the first quarter of the year with a bang. NASDAQ leading the way, up nearly 17.1%, while the S&P advanced 7.5%. And we get even a live update from Sandra there. Dow Jones did tick up 0.9% as higher as well here in Q1. And then global markets had a solid month. MSCI EFI posted a total return of 8.6. MSCI World ex-US nudging up 8.2 as well in Q1. Then going a level deeper here, taking a look at sector level performance, 7 of the 11 sectors within the US had positive returns in the first quarter, with tech and communication leading the way, posting 21.6 and 21.1% respectively. While financials was the farthest behind, posting a negative 5.5% return for the quarter, followed by energy and healthcare with negative 4.3% each. and kicking it back over to Joe.
All right, Zach. Yeah, lots to cover there. Certainly a divergence there in sectors in Q1. And if we take that a step further here in quarterly performance, this table here shows the performance of key asset classes over different time frames, with the 1 year, 3, 5, and 10-year columns showing annualized performance in those time frames. Year to date and 3 month, the first and third columns there are equal to each other, as this data is good through the first quarter of 2023. And it was US growth outperforming the rest in Q1. Its 14.4% return in the quarter represents a solid rebound after what was quite a sour 2022 for the equity style. And broad stock market indices did well, not just domestically, and across the globe as well in Q1. World ex-USA posted an 8.2% gain, and the S&P 500 stateside advanced 7.5%. Emerging markets also up 4% in the quarter. And now we'll take a look at some similar data here. This performance quilt just showing a quarter over quarter representation going back 15 quarters. All asset classes had positive returns in Q1, with the exception of commodities that sunk nearly 5%. Once again, we see US growth at the top of this list, coming off 4 consecutive quarters of either under or negative performance. So nice to see a rebound once again for that asset class there. You can also build your own asset class quilt using our Excel add-in. This plugin allows you to leverage dozens of templates just like this. Actually hop into the tool just for 10 seconds and show everyone, if you're not a client or haven't used our Excel add-in, how to do that. You just hop in here to YCharts and go to the tools drop down. All the way at the bottom is our Excel add-in, which you can download to Microsoft Office. And here's just a sneak peek of the dozens of templates that we have on offer using our Excel add-in. This one leverages the investment heat map. And here's just a preview of what you can build your own with here. It's really easy to use. Just download the template, punch in the tickers, the index symbols that you'd like to show in the heat map, and voila, you have yourself a nice heat map showing different asset classes that you can also leverage in communications with clients or internal colleagues. So definitely give it a check if you haven't already.
Awesome. Yeah, thanks, Joe. I know that Excel template is very popular with a number of clients that I work with as well. So moving on here to the performance of a couple standardized diversified portfolios. So we're looking at both returns and drawdowns over the past 12 months of a couple different risk-first return strategies, including stock to bond allocations of 80-20, 50-50, 20-80, and then a 100% equity portfolio represented by the S&P. So interestingly enough, all 4 strategies had positive returns in Q1 of 23 and are continuing toward even over the 12-month look back, while the most conservative 20-80 allocation is leading the way, only down there 3.47%. So this visual demonstrates that value diversification can provide investors during turbulent periods for both the stock and bond market. So obviously great for our own education or potentially for advisors' clients as well.
Yeah, definitely good to see a recovery in a lot of those diversified portfolios. And I'm sure clients of advisors are certainly happy to see the uptick in performance there. Now shifting a bit into bonds and interest rates. The first quarter of 2023 brought more action to an already inverted yield curve. We saw treasury rates continue to fall across the board, with the exception of the shorter term 3-month and 6-month rates. But the 1-year treasury rate ended Q1 at 4.64%, which is greater than both the 10-year rates 3.48% and the 30 years 3.67%. In spread news, the 10-2 spread was inverted at the end of the quarter, which hasn't been a surprise for quite a while. That differential, however, was 0.58% underwater, and the 10-year 3-month actually sunk to its lowest level in history at the end of Q1 at negative 1.37%. What's more, as of right now, May 3rd, when we're recording this webinar, it's actually even lower than that at minus 1.8%, which that in fact is its lowest level in history. So certainly interesting data for any recession watchers who incorporate yield spreads into their recession watch as part of their data for that.
ongoing saga for sure. So moving on now to the macroeconomic data. This first table that we're going to show is another heat map of various economic indicators, which are all considered to be leading indicators and showing trends over time. So the first four columns only showing the four most recent quarters here, and then the following 12 going year by year for the last 12 years. So the 10-2 Treasury yield has continued to drop beyond levels that it hasn't fallen to in over 40 years, as Joe was just alluding to. And the Philly Fed Manufacturing Activity Index actually sank by another 9.5 points, though the NY Fed Current Business Activity improved by 7.5 points. Building permits, housing starts, retail sales all fell. However, the slump across most economic indicators, as we saw earlier, didn't really stop the S&P advancing from another 7.5%. So slump across the board with equities still rising. Next slide then, looking deeper at trade activity between the US and key partners through the end of 2022. So the chart on the left shows that US imports have declined from their high, now just below 1 trillion per quarter, while exports have also declined just ever so slightly. The chart on the right then shows the divergence between trade imports versus exports, bouncing off of its lowest trade balance ever recorded in Q1 of 2022. So we see a very sharp jump there at the end of that chart. And then the table at the bottom shows just how imports and exports have increased in all regions except China on the import side, which declined 15.8%. Overall, exports increased in most of the European Union, 21.8%. Goods exports increased 20% in the EU, while services exports increased 25% in Mexico. Overall, imports increased the most in Canada, about 20%. Goods imports increased 70% in the EU and Canada, while services imports increased 35% in Mexico. So an uptick across the board there.
Indeed, it is a lot going on there in trade balance news, and even more so with housing market data. We know that in 2021, that brought its lowest 30-year mortgage rate in decades. But since then, mortgage rates have shot higher. The 30-year topped 7% at the end of 2022 and is now settled at 6.32% at the end of Q1 2023. This, in turn, has caused mortgage originations to decline further, and both the current and near-term outlooks for home sales rebounded off their lows set at the end of Q4, according to data from the National Association of Home Builders, the NAHB, and Wells Fargo. We also have a list of indicators there in the bottom of this table. We see that 3 months ago, the 3-month change for the Case-Shiller Home Price Index has fallen by about a percent. But overall, housing starts, building permits, and that 30-year mortgage rate are slightly down in the quarter, but certainly a lot more to see on the horizon in terms of housing market data. And like was alluded to in the chat just a little while ago, the Fed raising again. We'll see where that takes interest rates, such as those of mortgages, here in the near future. And looking at US dollar strength, the strength of the US dollar was up and down in Q1, but still settled down from its Q3 2022 high. Dollar to euro, dollar to pound sterling, and dollar to Chinese yuan rates all fell further from their 52-week highs in Q4 2022. The US dollar to Japanese yen was the one outlier, which increased by about 0.7% in Q1. The US dollar to euro, to pound, and to yen are all below their one-year averages still. And we also see there at the top chart how the divergence between CPI and the purchasing power of the dollar has continued to shrink amidst persistent high inflation. And before we get on to our last segment here, just want to let everybody know, please feel free to drop any questions you have about the economic summary deck, our economic data in general, or just the broader picture using the Q&A function. We'd be happy to answer them at the end for you.
Awesome. Yeah, Joe, it sounds like, traveling internationally might be a little bit, less advantageous than it was a year ago, but maybe buying a house would be a little bit easier with mortgage rates slightly falling there. All right, getting to our final segment here, and definitely a crowd favorite with charts of the moment. These are great options for you guys to be repurposing in conversations with wealth management clients, or obviously, again, for us to stay on top of the market. So we jump to that first slide here. We'll take a look at the 10-2 Treasury yield spread. There we go. All right. So as we mentioned earlier on, this 10-2 spread has inverted to its lowest level in over 40 years, and has been inverted since July of 22. And the lowest point that it hit was negative 1.03%. So typically a negative 10-2 spread has been followed by a recession, with the exception of the brief recession we saw back in 2020 at the advent of the COVID pandemic. So question remains, will a recession occur in the near future? Only time will tell. This is a great chart to be able to give folks a little bit of historical context there in terms of some of those leading indicators. All right, next slide here. There we go. Gold glittering and oil slumping. So amidst persistent inflation, we saw the price of gold per ounce finished just below $2,000, whereas the prices of WTI oil, on the other hand, slipped about 5.6% throughout the quarter. So perhaps even more interesting and more applicable to the day-to-day consumer, the average price of regular gas increased 6.1% to just above $3.50 per gallon.
And with gas kind of piggying back off of that, looking at the state of the consumer these days, both the U.S. Consumer Sentiment Index and the Consumer Confidence Indicator rose slightly actually in Q1. However, consumer sentiment remains well below its 85.7 average, and the Consumer Confidence Indicator is 2.7 percentage points below 100, indicating weakened consumer confidence, if that number is below 100, which it is. And additionally, the U.S. net percentage of banks reporting an increased willingness to make consumer installment loans declined double digits in Q1, falling 12.5%. We definitely see some shakiness in the consumer still, is what these charts might be showing. And hopefully with some of the rebounds that we've seen in equities in Q1, perhaps the consumer may feel a little bit of a lift there, a little bit of a tailwind as we propel into 2023 further. And on to more state of charts here, looking at manufacturing and services, the U.S. ISM services PMI indicator is at 51.2 as of Q1 2023's end. So just above that 50 level, that would indicate an overall expansion. But the same can't be said for the manufacturing side of things. That number continues to plummet below 50, now sitting at 46.3 as of the end of Q1. So we do have a bit of a divergence here with services just barely in that expansion territory. Manufacturing, on the other hand, the picture's looking a little bleaker as we've gone these past few months and this quarter.
Awesome. And then we'll wrap up the charts at the moment here with everybody's favorite in cryptocurrency. And looking here at both Bitcoin and Ethereum. Historically, back in 2022, they lost about 2/3 of their values. So that chart we see along the left-hand side there showing that sharp drawdown of both Bitcoin and Ethereum. But in Q1 of 2023, we saw a pretty strong rebound with Bitcoin rocketing up about 68.5%, with Ethereum, surging up to nearly 50% from where it stood at the start of the year. So bit of a comeback on the cryptocurrency side of the world.
Yeah, and indeed, for any advisors that are using crypto out there, might be worth giving it a second look, depending on your investment strategy, of course. But after a tumultuous 2022, we certainly see that all talked about asset class on the rise again. And that will do it for us, folks. Thank you once again for joining us for this YCharts Economic Summary Update for Q1 2023. We do have a couple questions in the chat that we can get to real quick. Douglas asks, can you add additional indicators such as leading, lagging, and coincident indicators to the leading indicator chart? The answer, Douglas, is yes, you can. Let's go back to that slide here. And we won't do this live here within the demonstration of the webinar, but you are able to add any indicator you so well please from our library of over 500,000 economic indicators and create your own heat map right here. So definitely take a look at that. If you are a YCharts client, definitely reach out to your account rep. They'd be more than happy to assist you with that. If you're not currently a client, you can also get started with a free trial, and your account rep during that trial can get you set up here with adding any indicators that you so choose. And Sandra asked thoughts on the level of the recession. We will say, Sandra, that we are not necessarily experts really in that regard, but what we can take a look at here from the charts that we see with the yield spreads being heavily inverted, we do know that every recession since 1970 has been preceded by an inverted yield spread. So you would think signs ought to point to a recession potentially coming down the pipeline, especially with the 10-3 number being the most inverted that it has been in its history, according to our data. So that's what we would say on that front. But again, as we said, the disclaimer, not investment advice, just looking at what might have happened historically there. And finally, Brad asks, any charts on the tax loss harvesting trade? Seems like the impact was especially large this year with some of the reversions we saw in Q1, backed by little fundamental business success. We can definitely pop into YCharts there, Brad, and take a look at that. One thing that you're able to chart in our stock screener, fund screener, and comp tables tools, as well as I believe our fundamental charts, is you can actually look at returns based on tax adjusted returns. So annualized all time, 1 year, 3 year, on monthly basis, on annual basis, and so on and so forth. There's definitely a lot of good information in there that you'd be able to play around with on your own accord. Nothing that I can think of right here on the spot, unfortunately. But if you were to go into YCharts and play around with that, there are definitely great insights that you could generate with our tools at your disposal there. And so without further ado, I think we'll wrap it up there. Once again, everyone, thanks for joining us for this quarterly economic update. Zach, it's been a pleasure having you with me at my side here, and we hope to see you all again in about 3 months' time to look at Q2 2023 and what has happened in the first half of the year. Thanks again, everyone, for joining, and we'll see you soon.